The basic reason is that the fundamentals started changing from the beginning of last year. They started moving to an easier market. Supplies kept on rising and at an increasing rate, and demand started, the incremental demand started declining because of China's slowdown and Europe's problems, etc. So the difference between the two widened. This led to, very simply, to more stock builds, higher stock build rates than before. So we had now stocks globally building. And when stocks started building and demand was not growing at the same rate, stock cover, the number of days of forward cover in the world, commercial stocks, this I'm talking about now, started to rise ever more. And they went from roughly 44 days in the middle of last year to about 48 days by the end of the year. Now, 4 days extra stocks in the world, commercial stocks, represents a very large amount of oil, about 300 million barrels plus. But the market generally didn't quite understand what was going on, because some of this data is not immediately available on a global basis. So, and the market was also distracted by events that were taking place last summer, mainly to do with the Middle East, and the sudden appearance and expansion of the Islamic State. This was a new group of people who had started in Syria, but they were now moved into Iraq, and this was threatening the stability of the Middle East. And by the way, the Islamic State is still active, it is still fighting, it is not far from Baghdad in Iraq, still there. And of course in the north they captured Mosul, a big city in Iraq, and very recently they destroyed equipment at the Beji refinery north of Baghdad. So it's still a threat. But last summer, going back to last summer, the fundamentals were weakening, and yet the market was worrying about where ISIS will go, the Islamic State, and the prices stayed high. But over time, into July and August, stocks kept on rising, the gap between supply and demand kept on growing, so prices started to slip, especially when the market sort of realized that the ISIS threat, the Islamic State threat, was not as great, because the allies, led by the United States, the Iraqis themselves, the Saudis, started bombing the Islamic State's position. So things looked a little bit better, and the price started sliding. And when the price starts sliding, the market itself starts to think about the situation and starts to worry about how far can prices fall. Now, the futures market, and I think I showed it in my presentation, began to worry about the excess oil, and the speculators on both NYMEX and ICE, the ICE market, and I've shown some statistics on that subject, started to contribute to the fall in price by selling oil positions, by increasing their short positions, and pure speculation I'm talking about. So this contributed, helped the price to keep on falling. And then we go to November, when the OPEC meeting was held, the regular meeting on the 27th of November. And before that we had some idea that the Saudis were going to maybe do something different, but we weren't sure. But at the meeting the Saudis showed that they were not interested in cutting production, as they had done on a few occasions before. They were not interested in preventing the price from falling. They were interested in maintaining their market share. The Saudis, and therefore they didn't agree in Vienna in November last year to cut production, either themselves alone or with the others. Many people think that this was the right decision to take, because let's say they cut production either collectively or just Saudi Arabia, and the price went back up again to not $100 plus, but maybe $70, that this would encourage the shale oil producers to keep on producing. So the Saudis probably took the right decision, that you have to stop this expansion in shale oil, which is the marginal barrel in the oil business today, and some Canadian oil sands production, but mainly shale oil. And of course, duly, investment in shale oil they stopped quite dramatically, but shale oil production continued because there's momentum, and operating costs are what matter in the short run, not the fully built up costs. So the price kept on sliding until early January, 13th of January was the lowest point. And then we had a rebound. Now, why we had a rebound is a complex story. It shouldn't happen because the excess supplies in the market are still very large, and even in the second quarter where we are now, the excess supplies are huge, even more than they were before last year, even more. But the price rebounded, and in my opinion, speculation this time didn't have much to do with the rebound. What had to do with the rebound is that the market itself started looking ahead. All markets, most of the time, look ahead rather than backwards. This includes the stock market. Stock market's usually looking ahead for companies, not backwards. And the oil market started looking ahead and saying oil production is bound to fall in the United States. Shale oil production is bound to be cut back at some stage or another. Demand is bound to pick up, and there were some indications in January, February that demand was actually year on year in the United States picking up because of the low prices. So the markets looked ahead and said, hey, we might have a little tighter market than people think. Therefore they reversed this pessimistic view and started maybe buying some oil futures. Buying oil futures leads also to more spot price increases because they are connected, the two, in a complex way through hedging. And now we've had that rebound. There was a little fall in March, and then now we have a second little rebound. But of course, behind this, there's the fundamentals are still very weak, exceptionally weak. The stock build in the first quarter globally is estimated at 2.75 million barrels a day. And the second quarter is around 2.8, slightly higher. So there are huge stock builds in the first half of this year. And according to economic theory and what's going on with stocks, with inventories, we should be seeing weaker prices, not prices at $63, 65 for Brent. So this is the great mystery. And my worry, and this is my final my final words, maybe this time we're making the same mistake as we did last year by expecting prices to recover at a time when the fundamentals remain very, very weak. So this is where we are, and time will tell. We shall see whether this happens again, whether prices begin to fall again, or whether they stay at these levels.